You are at lunch with a coworker, same company, same title, same salary. You both make $100,000 a year, but something's bothering you. He just bought a new car, not a cheap one, a nice one. He's talking about a vacation home, a little place upstate. You're still renting, still driving the same old Honda, still wondering how you'll afford a down payment. Same salary, same job, same hours, but completely different lives. What's the deal? Is he in debt? Did he inherit money? Is he secretly dealing something on the side? Probably not. The answer is simpler and quieter, and once you see it, you'll never look at your paycheck the same way again. Here's what's actually happening. You and your coworker have the same income, but you have completely different structures. He doesn't just have a job. He has a small business on the side. Nothing fancy, maybe consulting, maybe an online store, maybe some rental property, just enough to change the order of everything. And that order changes everything. Let me introduce you to two people. We'll call them Mike and Dave. Both end up with $100,000 in their personal bank accounts at the end of the year. Same money, same number, but the path that money took, completely different. And that path determines everything. Mike is an employee, good job, steady paycheck. Every 2 weeks, the company pays him, but before Mike sees a penny, the government takes its cut. Federal income tax, state tax, federal income tax, Social Security, Medicare, gone. Then Mike gets what's left. Let's call it $75,000 after all those deductions. Now Mike has bills, rent, food, car payment, insurance, gas, internet. He pays all of them. With after-tax dollars, what's left at the end of the month? Maybe a few $100, maybe nothing. Mike's path, gross income first, then taxes, then expenses, then whatever's left. Tax first. Now meet Dave. Dave has a small business, nothing huge, just an LLC. Dave's business makes $130,000 in revenue. First thing Dave does, not pay taxes. First thing Dave does is pay expenses. His car, business expense. He uses it for client meetings. His phone, business expense. A portion of his rent, home office deduction, health insurance. Business pays it, deductible. Meals with clients, deductible. Continuing education, deductible. Dave's business spends $30,000 on things Dave would have paid for anyway. But now those things are paid with pre-tax dollars. The business's revenue is now $100,000 after expenses. Now the business pays taxes on that $100,000, corporate rate, lower than personal rate. Then the business distributes the rest to Dave. Dave gets $80,000 after corporate taxes. Now Dave pays personal tax on that distribution. Preferential rate, maybe 15%. Dave ends up with about $68,000 after all taxes. Wait, that's less than Mike's $75,000. So Dave is worse off? Hold on, because we forgot something. Dave's business paid for $30,000 of his personal expenses. His car, his phone, his health insurance, his meals. Those are things Mike paid for with after-tax dollars. Mike needed to earn about $40,000 of his gross income to afford $30,000 of those expenses. After taxes, $40,000 becomes about $30,000. Dave's business paid them directly, with pre-tax dollars. So let's add it up. Dave's personal bank account, $68,000, plus the $30,000 of expenses the business paid. Total value Dave received, $98,000. Mike's personal bank account, $75,000, plus nothing else. Mike's total, $75,000. Same $100,000 at the end of the story? Not even close. Dave came out ahead by $23,000. Same gross number, completely different outcome. Because of the order, this is the tax first versus tax last principle. Mike pays taxes first, then pays expenses, then lives on what's left. Dave pays expenses first, then pays taxes on what's left, then lives on what's left. Same destination, different route. One route has a toll at the beginning, the other route has the toll at the end, and when the toll is at the end, your money works harder for you along the way. Let's make this painfully concrete. Imagine you need a new laptop for work. $2,000. Mike buys it with after-tax dollars. Needs to earn about $2,800 to have $2,000 after taxes. Works extra hours, gets the laptop. Dave's business buys the laptop. Business writes off the $2,000 as an expense, reduces taxable income by $2,000, saves maybe $400 in taxes. Dave gets the same laptop, but it costs him $1,600 in effective lost money because the $2,000 business expense saved him $400 in taxes. Mike paid $2,000 business expense saved him $400 in taxes. Mike paid $2,800 with his time. Dave paid $1,600 worth of business money. Same laptop. $1,200 difference. Every purchase. Every year. Forever. Now think about retirement. Mike has a 401k at work. Can put away $23,000 a year. Pre-tax. Good. Dave has a SEEP IRA. Can put away up to 25% of business income. Up to $66,000 a year. Pre-tax. Dave saves more. Defers more. Compounds more. The gap widens. Now think about health insurance. Mike pays $800 a month for family coverage. After tax dollars. Needs to earn about $1,100 to pay that $800. Dave's business pays $800 a month. Deducts it. Saves maybe $200 a month in taxes. Dave gets the same coverage. For $600 a month effective cost. $500 a month difference. $6,000 a year. The gap widens again. Now think about the car. Mike's car payment, $500 a month. After tax dollars, needs to earn about $700 to make that payment. Dave's business buys a car, uses it for business and personal. Deducts a portion, maybe 70% business use. So $350 of that $500 payment becomes deductible. Saves maybe $100 a month in taxes. Dave's effective car payment, $400. Mike's, $700 worth of income, $300 a month difference, $3,600 a year. The gap keeps widening. Now add them up. Laptop, $1,200 difference over 2 years. Health insurance, $6,000 a year. Car, $3,600 a year. Retirement contribution gap, more tax-deferred space. Meals, another few thousand. Phone, another few hundred. Home office, another 1,000. Suddenly, Dave is living a life that costs him maybe $70,000 in effective money, while Mike needs to earn $100,000 to live the same life. Same life, different cost. Because of the order, this is why your boss is richer than you. Even when you earn the same, he's not earning more, he's just structured differently. He's playing a different game with different rules. Rules that favor the person who pays expenses first. Rules that punish the person who gets taxed first. Now, you might be thinking, this sounds like a tax cheat, like something illegal. It's not. It's the tax code, written by Congress, designed to encourage business ownership, designed to encourage investment, designed to encourage people to create jobs, and completely invisible to anyone who only ever receives a W-2. Let me give you a thought experiment. Imagine 2 houses, same street, same value, same mortgage. Mike owns his personally, pays the mortgage with after-tax dollars, $2,000 a month, needs to earn $2,800 to pay it. Dave's LLC owns his house. Dave rents office space in the house to his LLC. The LLC pays him rent. That rent is income to Dave, but the LLC deducts it, and Dave gets to depreciate the house and write off a portion of utilities and claim a home office deduction. Same house, same payment, completely different tax treatment. This is the architecture. Not bigger incomes, better containers, not working harder, working smarter with the order of operations. Now here's the part that might sting. Your boss isn't necessarily smarter than you, or harder working, or more deserving. He just learned one simple principle. A principle no one taught you. The principle of tax first versus tax last. Mike's life, earn money, pay taxes, pay bills, live on leftovers. Dave's life, earn money, pay bills with pre-tax dollars, pay taxes on smaller amount, live on more. Same effort, different order, different outcome. This is the invisible system, the one they don't teach in school, the one your company doesn't want you to know. Because if everyone knew, why would anyone stay an employee? Why would anyone accept being taxed first? Now, you might be thinking, this is great if you own a business, but what if you don't? What if you're just an employee, stuck in the tax first lane? Here's the thing. You don't need to quit your job tomorrow. You don't need to become a tycoon. You just need to start. One small thing, a side hustle, a freelance gig, a tiny LLC. even $5,000 a year in business income. That $5,000 opens the door. Suddenly you have business expenses. Suddenly you have a different tax form. Suddenly you're playing on the other track. Maybe you buy a laptop for your side business. Deduct it. Maybe you drive for Uber a few hours a week. Deduct your car expenses. Maybe you consult in your area of expertise. Deduct your home office. Start small. But start, because the gap between tax first and tax last compounds year after year. $5,000 this year becomes $10,000 next year, becomes $20,000, becomes a different life. Your boss isn't richer because he earns more. He's richer because he's structured differently, because he pays expenses first and taxes on what's left, while you pay taxes first and live on what's left. Same money, different order, different life. The question isn't whether you can become a boss tomorrow. The question is whether you'll stay an employee forever, not knowing there's another way, not knowing that the order changes everything, not knowing that the system was designed for the person who owns things, not the person who just works for them. Now you know. The only question left is, what are you going to do with that information?